Hey everybody, it's Michael Martin. Thanks for being here. Appreciate all the great feedback on the channel and on my interview with Sean McLaughlin from All Star Charts. I'm going to try to do interviews every once in a while. It's good to get another person's perspective on things, maybe do some point counterpoint. Today I wanted to share with you something that I've done that's helped my performance greatly. And it's not, unfortunately, a magic bullet on how to, make more money, but how to not lose. And it deals with a concept called portfolio heat. For most retail, non-professional traders, you probably have a protective stop in once you get filled on your trade. So you buy something long, you put in your protective stop, right, and you let things go. If it moves up a certain bit, you probably raise your protective stop to break even. Last year, a full fifth of my trades got knocked out at break even, to give you context. That's 1 in 5. And it's annoying when it happens, especially if you have to get back in at a higher price. All that means to me, though, is that the market wasn't ready to move from where my initial entry point was. And if it does go against me, I know I don't want to lose corpus. I don't want to lose or give back unrealized gains, or too much of them anyway. But I also know that I have to be in the trade to win it. So again, it's a good video. If you look at the YouTube channel, I think it's under the live tab, you can see a live stream that I did about my incremental exposure. So that's kind of what I'm getting at here, if you haven't already seen it. And so what I would do is I would raise my protective stop. I would add more, right? And I wasn't a pyramider, but I would add to my winners. And the amount that I would add were asymmetric. I wouldn't necessarily always add the same amount. It all had to do with where the market was, what else was happening in the rest of my portfolio in the other positions. Where am I in the month? Right? Because earlier in my career, I used to kind of, not doctor my track record, but I'll come back to that in a second. If I was up, say, 13% for the month, and we had a week to go, because track record is what you're marketing, I would say to myself, okay, I want to have a double-digit month in my track record for marketing purposes. So if I was up 13%, I would say I'm only going to give back, say, 2.5% or 250 basis points for the rest of the month before I stop trading, so that I could legitimately print a 10.5% rate of return, for example. But as traders would go, I wasn't just trading one instrument. I know a lot of you might be doing MNQ or the indices, and it's like risk on, risk off. That wasn't going to move the needle for me, because I really wanted to become wealthy, right? So I knew that I had to leverage my time and lever my money. And leveraging the time meant I had to do my research to be prepared. I needed to put the trades on. I needed to manage the risk, because that's what we do. We're risk managers. But then if the move was going to continue, it became very clear to me that I didn't have enough on. And that if the thing was going to move, say, 10%, that might only move my account balance, say, 2%. And that would mean, like, okay, I need 50 trades like this. I have no idea what the market's going to show me, right? You can look in December when they do the breakdown, like, what are the best trades? You might find that there's only 3, 4, maybe 5 big trades where something doubled or tripled or what have you over the course of the year. So my mind was like, I don't know how I'm going to do it yet, but those are the names that I need to be in. Right? And I might miss one because it's not my setup or what have you. Might miss 2. I don't know. But if that's the case, then something's definitely rotten with the state of Denmark. And so I need to look at my own behavior and say, why am I missing these? And then why, if I bought something at 100 and it went to 120 and I sold it, kind of clicking my heels, and the thing goes to 180, I can't celebrate that as a win. Because if you don't get that, I think you're missing the point. So I wasn't going to try to make all my money with a bunch of paper cuts, right? And neither gains nor losses, right? So what I would do is I'd have 3 or 4 names in the portfolio. It could be a stock, it could be a commodity. I was trying to use as much leverage as I possibly could, not on day one, but I'd I'd add to my winners. And like, I had a big sugar trade in 0506 where I bought, you know, the account was 50K. I bought two contracts, then I added one more, then I added two more, and then the thing went sideways for like 6 weeks and I was still in the trade. It was, October, say November. So March of the next year was the contract. So I had plenty of time. And then it crossed over like 12, and then I bought five more. I doubled my position. Then it went up, and I bought three more. And that was very a hallmark of my trading style, is that I'm always marking everything to the market with risk, volatility, what's happening in the rest of my portfolio. And then, so the tip or the trick that I can share with you, besides the incremental exposure, is when I would look at my overall portfolio and you'd say you were risking 2%, right? In those days, you were trading a little bit more aggressively, and you'd have a 2% risk unit on, and say you had three instruments in your portfolio. So your portfolio heat would be the sum total of all of that. How much of your capital is at risk on each of those positions, and you add them all up, right? So if you're risking 2% and you have that going three times, you could say your portfolio heat was 6%. Now, some of you might be like, that's insane. Well, it's not insane when you conjugate it with what is it that you want your money to do for you, right? You can't make 1,000% on your money if you're risking 25 basis points or $50 on the MNQ. It's not going to work because you don't have enough risk. If you look at any of these, peacocking trading contests that are out there, and anybody has, triple-digit returns, those are coming from great degrees of leverage. A handful of names, one, two, maybe three names, levered, either with Reg T or day trading buying power. So if you have a fantasy of trying to make large gains, it's not going to come by risking, say, $50. Now, if you have a $1,000 account, of course, you can do that. It's easier to do with smaller numbers. But once you come into substantial means, it's much more difficult for a whole bunch of reasons. So you think in terms of portfolio heat and say, okay, because then you're going to say, if you have this asymmetric potential, well, that's how you make 30%, right? If you have 5-1 and your portfolio heat is 6, right? That's how you can figure out what your upside is. Is that really worth your while at that point? Because especially if you're taking your winners too soon, you never give them a chance to grow. It's like planting a garden, and then as soon as the tomato plants start to flower, you decide to chop them down because they flowered. Now, I that's not how I'm built. I needed to use trading as a vehicle to build substantial wealth. So the way I kept my losses small and all of that was, if I had, say, 6% portfolio heat and I had bona fide stops in, there might be a time when everything was moving against me, but not enough to get stopped, you see? And if you come in to any given day and say, well, I don't want to lose more than 2%, you could find yourself with three different names. Say you were down, each one was down 0.5%, so you're down 150 basis points. And what I would do is I just puke out the whole portfolio. I would offset, because that's managing now a basket of securities. Again, many of you might be just trading one instrument, so this might not resonate with you. But to me, the opportunity cost of just trading one instrument means you could be leaving a lot of money. You're not even leaving it on the table. You're not even getting it inside the house to get on the table. And that was just way too expensive for me, because I knew if I didn't make it in trading, I'd be back at the golf course or waiting tables again, and I didn't want that. I had done that enough, and I was good at it. I made a lot of money. But I was very clear that I wanted to have white-collar, job. I wanted some type of intellectual property, and I wanted my money to, it sounds funny because I wanted to make money for not working, which is another way of saying I wanted my money to work for me. So that's why I designed a trading model where I could put money to work and let the leverage work for me, levering my time, right? Because now it was like two of me. I was working for my money, but now my money was working for me. And so I didn't want to turn trading into a blue-collar job where I had to sit in front of the screen every day and get excited about scalping 50 cents. It's not how I was built. It might work for some of you, but it wasn't going to be enough money for me. And and this happened, puberty and trading happened for me like this, where, I made my first $200 on a trade. And when I looked at the commissions and then what the taxes were, I was like, this isn't going to work. It felt good. It felt because I wanted to be validated. I wanted to be able to say that I put on a trade and I made money and it validated me. And then afterwards, I was like, well, that's stupid. Who needs the validation? I don't care what anyone else thinks. I got to grow this 5K up to 50K. I don't have any money. I can't put on certain trades because I don't have enough to risk. And my buying power gets allocated very, very quickly. So, I'll be telling you a lot more stories about, these types of things. Maybe I'll do it in a book. I don't know. It probably wouldn't be a trading book. But this is how you preserve your capital when the markets aren't going with you, but you haven't gotten knocked out. I know for a fact I would do this on a Thursday or a Friday. I didn't like taking trades home that were either in small drawdown or collectively in a drawdown. Meaning, if you had gold on and you're up, 50K, and you finish the week 35, I would have to make a decision and say, okay, is this thing rolling over? Or was it just profit taking? And in those days, there weren't the minis or the micros. It was just COMEX gold, 100 ounces. And if I had sugar or Wendy's or some other type of position on, or corn, because I had stocks and futures, but my equity net wasn't going up. There were plenty of times where I would just puke out the whole portfolio, go home with a clear head and say, the momentum must have stalled. And I don't want the momentum stalling. You certainly don't want that with options because it shows up in the premium, the time value. It collapses on you. And so I was just like, I'm going to puke out the whole thing. And that little trick preserved so much of my capital because, yes, things do ebb and flow. And I was probably trading much more momentum in those days. But the diversification was supposed to help me not lose money. So, yes, mark everything to the market and put in your protective stops on a per instrument basis. But then from back testing, and I did this on spreadsheets and I did this through simulators, there is evidence that you can have better performance if you puke out the basket or whatever, like I call the basket, like whatever is in your portfolio all at once. And I know, professional traders do that all the time, and you can borrow from that. I know that, everybody from Steve Cohen to the late, great Ace Greenberg, it was in his book. They could have something that would be the bluest of all blue chip stocks, could be McDonald's, AT&T, IBM. If they bought it on a Wednesday and it was showing a loss coming into Friday's close, they puked it out. They never took home losers. Now, some of you aren't taking home winners, so this conversation might not resonate with you. But, again, the only way you're going to make big money isn't by taking paper cut wins over long periods of time. I completely disagree with that. Now, you might say, well, so-and-so did it and they made 100K. If that's a lot of money for you, awesome. It wasn't going to move the needle for me. So, again, I wanted to lever my time and my money. I wanted my money to be a clone of me, Michael Martin, right? So I wanted, in the perfect world, to have my positions moving for me, my protective stops entered into the market, momentum in my favor, wind at my back, and have those positions on for weeks and months, right? I've had commodity positions on for months in one trade before I had to roll. So that was going to compound my net worth, which is what the goal was. I let go of needing the daily green days. I didn't care about that. That to me was showed mental weakness for me. It showed me that I was too eggshelly. I was too insecure. And thank God, again, I was just born this way. I got beyond the need for the green days every day. I didn't get excited about making small money. Now, admittedly, at the beginning, I had to go through that because if I made $500 a day, I was like, okay, there's one night at the restaurant, right? Because those guys were throwing dollars like Leonardo in that movie, Fun Coupons. And then also with Caddy, and it was easy to do $500 a day. So I was like, well, I need to make more than that. And if my thinking is right, I need to do more in trading than what I could do in my blue collar jobs. Otherwise, what's the point? I changed my environment, wearing nice clothing. I guess it's better than being outside in the blazing sun, and being on your feet all day. So there's that trade-off. So maybe there's a quality of life thing, but it was still the same money. It was worse, actually, financially, because in the restaurant and the golf course, I was going home with cash. And you know what that means? Everything on Wall Street was documented and came through a paycheck or a 1099. So I needed to do, almost 140% when you think about taxes, deductions, and 401k and all this other bullshit, to have more or at least the same take-home pay. So this all went into my trading model. You might, this has nothing to do with trading, but the goal for trading for me was, and this might help you in your goal setting. Point B wasn't to go from blue collar to white collar trader so that I could call myself a trader. That it was a vehicle. I was going to use trading because I have no allegiance to anybody or anything. Trading was a vehicle for me to use so that I could put my wits against everybody else and come out ahead, because I wanted what was beyond becoming a trader. And it wasn't like fancy cars and all this and that. It was, I wanted financial stability. I wanted financial abundance. I needed to lever myself. I needed to create another version of myself so that I could improve my financial standing. I had already known that I had a work ethic. I was doing the stuff that Goggins and Jocko were talking about now when I was 12 years old. There's nothing new for me there. Oh, great, Can't Hurt Me. I get it. It was a good book. But that mindset was nothing new to me. That was who I was. That's who I was. And so maybe this will help you think about how trading is serving you. Like, it's not about being right. It's about making and, applying yourself, learning your craft, and making, large sums of cash so that you can have a high quality of life. Now, like for me, there's philanthropic, things that I'm doing. So the corpus has to be there. You can't be a philanthropist if you don't have money. So, that was kind of always the goal. The trading was just a stop on a longer train ride, to get where I was going to go. And in order to do that, I had to make sure, given the leverage that I was using, that if I smelled smoke, I had to assume that it was the beginning of a 5-alarm fire. So again, just to close, put in your protective stops for every one of your positions. But then if you notice that net, the names are kind of leaking against you, they're not making big losses, but they're not moving, maybe momentum is stalled, you can preempt your protective stops, puke out the whole portfolio, come back the next day and see what happens, right? Especially today, because there's no commissions. Effectively, there's basically no commissions. Anyway, please like and subscribe. If you haven't already gotten a copy of the Inner Voice Trading audiobook, you can get that in the link below. There's also a link if you want to contact me about suggesting a show or some coaching. Have a great week.